talking about a $1 to $1.5 trillion debate of value on Nvidia.
This most recent quarter is as good as it gets, right? Because those customers that we've been talking about just increased their CapEx by the largest amount ever.
I don't care what the company says. Let's go down the list and see what the top 5, 10 customers are saying and what's their behavior, what are their returns, because that will dictate ultimately what they spend.
This level of buying from Nvidia's customers is not sustainable. There was a period of time where they had exponential growth. We're coming towards the end of that. In that S-curve, we're coming up to that inflection point from exponential growth to more moderate growth.
Hello and welcome, everyone. My name is Doug Garber with Pitch the PM. I'm here with Gil from DA Davidson. He's the head of technology research. And today we're going to be discussing Nvidia, ticker NVDA. And we're going to try and structure this as a casual conversation, the way it would be as if Gil were to come into my office. As you know, he's the analyst, I'm the PM, and we're just talking about the name and trying to learn more about it. So with that, I'll hand it over to Gil for a quick introduction.
Yeah, I will keep it quick. So first of all, DA Davidson, 9-year-old investment bank brokerage, headquartered in the Pacific Northwest, Seattle, Great Falls, Montana, and I reside in Portland, Oregon. I've been covering technology stocks for 25 years or so, and I've covered all the different types of stocks: telecom services, telecom software, e-commerce, fintech, payments. And these days I cover technology more top-down. So the Mag 6, the 6 biggest technology companies, as well as another 40 or so software companies, mostly so I can have a good sense for what the trends are, where things are headed. And for that, in order to do that, it's really the biggest companies that make all the difference, and especially the one we're talking about today.
Great. And real quick, DA Davidson is registered with FINRA, so we'll put up these disclosures of where they're market makers right there. And Gil, are there any other, when you cover NVIDIA and these other companies, do you speak with them quarterly? Do you speak with the IR? Do you speak with the CFO? Do they come to your conference? What's your relationship like with NVIDIA and their top customers?
At the very least, we check in quarterly on their earnings. With companies that we pay more attention to, like NVIDIA, we also talk to them intra-quarter. I had even a chance to speak with the CFO a few weeks ago. So we do try to pay attention, talk to the management teams. They don't do a lot of conferences just because they have so much coverage that they can't get to all of them. So we talk to them intra-quarter, often with IR, sometimes with the CFO when it makes sense.
How many of their customers do you talk with and how regularly? And are you talking with the actual purchasers of the NVIDIA products, or are you talking with the kind of C-suite or IR that's a little more polished?
Well, as it happens, because I cover the rest of the Mag 6, I talk to their biggest customers every quarter as well, at least every quarter as well, right? And this is a conversation I've been having with Microsoft, Amazon, Google, and Meta, who are 4 of their largest customers, really almost every time I talk to them, because my sense was that this would become a very important investing topic for them. And specifically for Microsoft, what we've seen is Microsoft's issue over the last 6 months has been that they're investing too much for too little growth. And so this has been a topic of conversation with them about their data center spend, what chips are they buying. And so that keeps us in the loop of what NVIDIA's customers are thinking. We also recently picked up coverage of Nebius, which is another type of customer. CoreWeave filed to go public. Nebius is already public. Those are other types of customers. So we talk to them as well to get a sense for that part of the market.
So it seems like you have a broader view, whereas maybe most of the, call it 60, 70 analysts are either semi-analysts or software analysts. You're looking at more of the entire ecosystem. I'm sure there are a couple others out there that do that as well, but that seems to be somewhat of a differentiator here.
That's exactly right. I think if you look at where the conversation on NVIDIA was, at least up until a year or so ago, up until 9 to 12 months ago, it was almost entirely about just extrapolating current growth forward. I'm a semis analyst. There's a data center market. It's going to grow 40, 50% a year for the next 10 years. NVIDIA is going to keep 80, 90% share. Therefore, it's going to the moon. I think that was the extent of conversation. Semis analysts also spend a lot of time on the technical aspects of it. Chips on wafer on substrate. What's the capacity at TSMC? How much 2 nanometer capacity there is? Very bottom up technology view of semis. And there was a little less conversation about, oh, okay, well, who are they selling to? Can they keep selling at these rates? Are their customers going to really increase their demand by 40, 50% a year for the next 10 years? Is that really a possibility, given that they are also publicly traded companies with shareholders that have their best interest at heart? So that conversation has improved and morphed over the last 6 to 9 months, and therefore, and I think that has a lot to do with where we are today in terms of NVIDIA being more of a stock that's being debated as opposed to where it was 9 months ago, which was really a monotone to the moon type narrative.
Do you spend a lot of time in Asia doing supply checks? I know a lot of semi analysts kind of spend time kind of going around and seeing how tight the current quarter is and trying to figure out how much can they get out the door. Is that something that you do, or you're more customer focused?
Big picture, top down, customer, how this fits in the world, how this fits in the ecosystem, where the trends are, as opposed to going to China to do that. There's, to your point, there's 60 something other analysts that do that, and I'll let them enjoy those trips.
Where do you see the current debate on NVIDIA right now?
Yeah, I mean, I would define the bull case is we're going to keep doing what we've been doing. So their customers will keep buying. They'll keep buying more every year. There's new types of customers coming in. We're still supply constrained, and therefore NVIDIA can keep growing at 20% plus rates for the next several years. And if you look at the ultra bulls that I think are driving some of this narrative, they think NVIDIA can grow 40% plus next year, not this year, next year, and then grow on top of that after that. That's the bull case. If they're right, and we never want to dismiss the bull case, if they're right, NVIDIA could do 550 of earnings next year, trade at 30 times that. That's 165. It's a valid bull case. You and I are going to talk about why I don't think that's going to happen, but that's a valid bull case. The bear case has many elements that we're going to cover, many of them in our conversation, but the highlights are that their largest customers will not continue to spend at these rates. They're not going to continue to expand at the rates that they've been expanding, that the customers behind that probably don't have the capacity to expand either, especially since a whole category of customers in China may be further restricted going forward. That's one element that demand will likely roll over. Part of that is because there isn't yet a real compelling return on investment results from the deployment of AI. That will mean that demand will moderate. The second part is that NVIDIA will not continue to have 80 and 90% share. They have some inherent structural advantages, but two of their biggest customers, Google and Amazon, already have chips that they're using really in conjunction for now. But as the further we go forward, instead of NVIDIA, Microsoft's working on its own chips. Even Meta and Tesla are working on their own chips. I just listed most of their large customers. The Chinese customers, to the extent that they still have access to these chips, will be buying Huawei increasingly. They're catching up very quickly. So from a competitive standpoint, believing that NVIDIA will continue to have this type of market share down the road is a stretch. And then longer term, there's a whole question about whether we are going to be delivering AI through data centers at all. That as models get smaller, as those capabilities get so much better, the efficiency gains get so much better, we're going to be doing a lot more AI on devices, and therefore not in a data center. And so that whole demand may roll off at some point, where the most sophisticated uses we're probably going to, the ones that require the highest levels of compute, we're probably going to be doing on quantum computers within 5 or 10 years. So those are the tenets of the bear case. There's a lot there to unpack, but if that happens, we could be looking, and we'll talk about the fact that we have street low numbers for next year at closer to $3 of earnings next year. We won't be trading at any more than 20 times that. So then we're talking about a $50 to $60 stock. And so that's quite a bit of downside. So this is a high risk, high reward situation, especially from where we are right now, where the stock's trading right now. But again, we think that there's probably more downside than upside.
So you're painting a picture here of, if the street's saying, 550 times 30, you're talking $60 of upside to 173 or so. That's kind of the street target. You're painting a picture of, 3 times 20 is 60. So it's 50, $60 either way.
That's a lot of risk, especially for a stock that's a really big component in a lot of portfolios. Let's not forget that that's part of the dynamic that I know you've talked about is what's the incremental buyer, and when you look at the risk reward on the other Mag 6, it's far less. It's far less. You may not believe that Amazon's worth 250, but it's probably not worth less than 200. You may not believe Meta's worth 1,000, but it's probably not worth less than 600. So the ranges are far smaller on the outcomes for those companies that will be growing their earnings as well in a wide variety of scenarios that are not in a cyclical business, that are really overwhelmingly not in a hardware-driven business, and so that risk reward on Nvidia is pretty extreme.
So to sum it up, we're talking about a $1 to $1.5 trillion debate of value on Nvidia. That's plus or minus. We're right about 3 trillion today. You excluded Tesla from that. I think they're the seventh sometimes.
Yeah. When it quacks like a duck and walks like a duck, Tesla makes cars. I love Tesla. I've been Tesla owner for 12 years. I love the product, but it's a car company with this very valuable option on self-driving and on robots. I get that. But since you're getting negligible on self-driving and zero on robots for at least 5 years, then I don't think it's part of the calculation. Now, mind you, it is part of the calculation as a big NVIDIA customer. Elon himself, forget what company he's putting the chips in, is a very big buyer of GPU chips. And as we get into segmenting and talking about the specific customers, I'll argue he's one of the most robust buyers. He's probably one of the ones that will persist longer than some of the other customers because it helps him sell more self-driving, because he is very passionate about unseating Sam Altman and OpenAI, and he's investing there beyond rationality in Grok. And so he's a very good customer. He's not going to go away, but it's not to me, it's in a different category in terms of the importance to the overall technology ecosystem. I'd argue maybe Elon is important in the overall technology ecosystem. Tesla is a car company.
Right now, the current situation, NVIDIA is beating every quarter. There are shortages. People can't get enough of their chips right now. There's the arms race. They have, is it fair to say, 90% share of the GPUs right now today?
Pretty much. Of the ones that are sold, we can get into the nuance of the fact that Google uses TPUs for a lot. So maybe the overall installed base is less than 90%. It's 70 to 80%. But yeah, of the market of selling incremental chips to the marketplace, NVIDIA saying 90% is probably pretty close.
But 70 to 80% of the overall market included internally used ones. Almost a monopoly, essentially. Huge pricing power. They can kind of charge what they wanted during this arms race. That's the current situation. And they're beating earnings. Revisions, I kind of look at people like, are we in a bubble? And I look at the revisions and I'm like, well, the stocks, earnings have been revised up 2-3x, and so is the stock. So it's actually somewhat rational. Then you could debate the multiple a little bit. So it kind of comes down to future earnings revisions. And then you have this other mental model that sometimes you use for cyclicals, which there is some element of when the stock stops reacting to positive earnings, and only so that's kind of a sign that you're at the top. Now this is a compounder slash cyclical, so it's a little bit of a interesting model, and it's got this into the moon sort of compounder herd mentality, it seems. So I just want to kind of now dig in. I think the heart of the conversation, and the reason I wanted to kind of I want to speak with you on is because I approach things very much the same way. Is let's see what the customers are saying. I don't care what the company says. Let's go down the list and see what the top 5, 10 customers are saying, and what's their behavior, what are their returns, because that will dictate ultimately what they spend.
I want to step back a little bit and kind of get us to where you're at right now, which is there's no argument that NVIDIA is an incredibly important, successful company. Jensen Huang saw something nobody else did, and he built an unbelievable business that is very valuable and has driven a lot of the innovation. Without NVIDIA, we don't have most of this AI innovation. That is factual. So they've created a tremendous amount of value. And to your point, there was a period of time where they had exponential growth. We're coming towards the end of that. In that S curve, we're coming up to that inflection point from exponential growth to more moderate growth, right? The second derivative of growth is turning from positive to negative, right? But that means that we had a period of time where their beats were just enormous. They had that quarter where they're supposed to do 7 billion and they did 11 billion of revenue. That is probably the largest revenue beat in the history of revenue, in the history of business. So that's why the stock did so well, because there was so much momentum. The beats were so big that, to your point, everybody had to catch up on their numbers, which drove the multiple higher. So you had earnings going higher and multiple going higher, which is how we got to that peak in June of last year. But as you're pointing out, once the beats don't get quite as big, it gets harder. And what I'd say about the most recent quarter is I've been talking about this most recent quarter is as good as it gets, right? Because those customers that we've been talking about just increased their CapEx by the largest amount ever. Between Q3 and Q4, between Q4 and Q4 of last year, it was the largest increase ever for that cluster of customers. Microsoft, Amazon, Google, Meta, Elon, China, largest increase ever in CapEx, and they just reported that quarter, and it was unbelievable. But it was a reasonable beat. It was a moderate beat. We talked about margin issues. There's the upside to margins is also not where it used to be, and so it's harder for a stock to keep momentum when the beats get smaller, and when you don't feel like there's more exponential growth ahead. When you're just arguing about is it 10%, 20%, or 40% growth next year, it's not. It's a lot harder to get momentum in a stock that just had these types of massive upsides for a prolonged period of time, for about 18 months.
So you guys, when you look at this, do you look at it on annual growth year over year or sequential growth? Is there seasonality, or how are you thinking about that when you model and you look at the numbers?
Yeah, right now for NVIDIA, there isn't much seasonality. It's really the mental model that most of the street has adopted, which is pretty close, is that they're going to add $4 or $5 billion of revenue every quarter. And that's been pretty predictive for the last couple of quarters. Again, without that much upside to it. And if you look at the estimates for next calendar year, it's really just people extending that into 2026. That you have to, and again, I understand that exercise, and I understand that that's what, again, 60 of the 65 analysts are doing. It's not an unreasonable approach. And we can talk a little bit about why it could happen, even if their customers start slowing down and the cycle starts moderating. The inertia could continue. Maybe it's worth talking about it now because it leads to some of the rest of the conversation. Jensen Huang is a brilliant man who has lived through many a semi-cycle, right? What's a semi-cycle? Demand grows first, supply can't catch up, prices go up, semi companies make a ton of money, but as supply catches up, demand moderates, supply overtakes demand, prices go down, semi companies go down, right? He's lived through that enough times now to know that he has an opportunity, and he still has an opportunity to manage the peak of the cycle. So what he could have done is supply all of his top customers with as much as he could, everything they can. Again, you could, if he just sold to Microsoft, Amazon, Google, and Meta, and Elon, he could have sold all of his chips. All of his supply could have gone to those companies, but then he would have had to deal with the peak cycle when those were satiated, and the cycle would have rolled over. So what he decided to do is take a page from the PlayStation 5 and create artificial scarcity. He did that by continuing to sell into China, and he did that by funding a competitive group of customers to his largest customers, CoreWeave, Nebius, Lambda, and others, by shifting half of the supply to those categories, 40 to 50% of the supply to those categories. He kept his top customers hungry. He extended the cycle. And he's created this additional demand and competition that will persist even when his top customers start moderating their demand. And so this is part of the reason NVIDIA may be able to keep growing sequentially, even when Microsoft just said there's going to be 2 quarters of flat spend. Amazon just said there's going to be 4 quarters of flat spend. It's not unlikely that Google will come up next quarter and say something similar, and that at some point Zuckerberg will become a little bit more rational as well. But now NVIDIA's created this other demand from China and from upstart competitors that this can persist. But as you can read between the lines, not sure that's a long-term strategy, but it'll extend the peak.
Well, that's a good thing in the near term because you go from 3 or 4 buyers to maybe 8 to 12. But now those people are now renting out GPUs by the hour. So then you now have 10 or 12 choices versus 3 to rent or actually do the compute. And then we can see the volatility we've seen some on the near term rental GPU per hour. And that's one of the things I want to dig in. It's understanding how deep is that market versus the term market, which doesn't seem to be as affected yet. And is that, canary in the coal mine sort of thing?
They're creating a lot more supply that will, and installed base that will eventually create the oversupply. And yeah, let's talk about some of the rental prices are public, so we can talk about them and those trends. And I completely agree with you that this is going to be a canary in the coal mine, that we're going to start seeing the excess supply. It's one of the first places where we're going to start seeing excess supply.
Are we not seeing it now? Because I used to hear anecdotes of $7, $8 GPU per hour in 2023 when things were really short. Now I'm hearing, $2, $1. Now that might be for the H100, which is now not the newest technology. So now that's lower, and they're paying 3.5 for term prices on the newer. I'm just looking for a little context on, is that normal that you pay for the newest technology, after 2 years you get the other technology becomes really cheap? Or help me understand more about that, what those numbers mean and what you're seeing.
Yeah, there's a lot of stuff there. So let's unpack a little bit. 2 markets. I'm a big enterprise, and I'm a Microsoft shop. Everything's on Azure. I want to do my AI on Azure. I'll pay them, let's say $6 an hour a GPU to rent out an H100, and I'll sign a 3-year deal to pay that. That is the biggest market right now, because again, most of the market is either enterprise customers or OpenAI's consumer business, which also goes on Azure, right? So that's one market. There's another market that is mostly served by these neo hyperscalers. Again, the big ones are CoreWeave, Nebius, Lambda, but there are others where you can literally rent an H100 by the hour, like a small grouping of H100s, like 8 H100s for a couple of hours if you want. Microsoft won't let you do that. Again, 3-year deals. 3-year deals for something you have no idea what you're going to do with, but that's what they're making you pay in order to get that capacity, which is in short supply, right? They've all said that they're supply constrained, that they're not meeting all their demand, which means they can continue to charge that price. So that's one market, and we can talk about what's going to happen to that market. The more immediate market that we are learning a lot from already is the per hour market. And again, you could go see what those prices are. And to your point, those prices have gotten halved in the last 12 months. So they went from $4 to $2 for an H200, $2 to $1 for an H100 just since last February. And this gets to an important point that you're also bringing up, which is part of the reason these big customers can't keep spending forever is that CapEx isn't free. CapEx goes into your DNA line, right? And it impacts your margins for years to come, right? If you're putting in server equipment, you're Microsoft, you're going to have to depreciate it over 6 years. The current rate for Microsoft, their current incremental spend, so Microsoft went from spending 12% of revenue on CapEx to 24% of revenue on CapEx. That's a full point of drag they're going to have to carry with them for the next 6 years. There's nothing they can do about it, just from what they've done so far. Every year they continue to spend at this rate, another point of drag on their margins that they're going to carry on for the 6 years after that. So we're already seeing their ROIC, which has improved gradually for many years, roll over and deteriorate, not to mention their cash flow is now declining, right? Microsoft, the great Microsoft, the biggest, most important company in the world, is seeing its result deteriorate because of this rate of investment. Then we get to well, how long can you hold this asset? They just went through last year, they increased their useful life for server equipment from 5 to 6 years, because at that time, they were able to convince their auditors that the stuff they were buying before, actually they used for a little longer than they used to, because the technology at that point was relatively stagnant. Their auditors are going to start asking questions pretty soon. If they're renting out an H200 and the price gets halved every year, clearly the useful life is not 6 years. And so not only are we going to have that point of extra drag on their margins going forward, there may be a step up that'll happen this year or next year where the auditors make them go back to 5 years, maybe even less, and there'll be an even bigger drag on margins, which goes to that main point that we brought up at the outset, which is this level of buying from Nvidia's customers is not sustainable.
Yeah, I was reading on the expert network on the AlphaSense search, and they were some of the experts, the former, Microsoft, Google folks were saying, the useful life could be 18 to 24 months before you replace it with something newer, or they say, well, maybe 4 years. It goes to. It's not going to go to 2 years so quickly. But it was just interesting to hear what people in the industry. Now, when these assets, the GPUs, are they worn out like a car tire, or are they just obsolete because there's something so much newer and faster in 2 years? How do we think about that?
The good news is I don't want to make Microsoft sound irresponsible. And again, when I say Microsoft, I also mean AWS and Google Cloud. They're not irresponsible. What they will tell you when confronted with this fact pattern is, hold on, these GPUs, these data centers, they're fungible, which is their way of saying, we will be able to do our traditional cloud hosting business with these GPUs in the future. That traditional hyperscaler business, which by the way will continue to grow because that shift to the cloud is still happening, and that baseline hyperscaler business is still a healthy one. Doesn't grow as much as it used to, still a healthy one. So what they'll tell you is these are fungible, meaning even if we can't use them to train AI models or to serve inference, we could still use that same data center to deliver basic cloud storage, which is a persistent business that is not changing. And that is an important point to say that, again, if I'm a Microsoft investor, as long as they start behaving responsibly, which it sounds like they're starting to talk about behaving responsibly, I'm fine. This is not irreversible damage. In fact, if Microsoft starts behaving responsibly and lowers CapEx into next year or in the year after that, then you're going to start getting a tailwind on cash flow and a tailwind on incremental margins as you ramp up the business, because you've overinvested and therefore you can take some time off. A good case study of this is what happened with Amazon on the other side of their business, on the retail business. During COVID, they had this massive investment in distribution centers that eroded their cash flow, put pressure on their retail margins. But when we got post-COVID and they realized they built enough of that distribution capacity, then they slowed down. And now we have record margins in retail because they've slowed down that rate of investment in distribution centers. So I think that's the dynamic we can look forward to for Microsoft, Amazon, and Google, is that once they have overcapacity in place, that means a couple of years that they don't have to buy as much, which will turn into a tailwind to their margins.
Let's just take Microsoft as an example. They're still getting 20% returns on capital with a huge amount of capital deployed. They're still growing, 30% in the cloud. Those are good, very strong attributes of a business. Yes, earnings have been revised up and free cash flow has been revised down, longer life assets. And I've seen this before where, call it Wall Street has said grow, grow, grow. Then they're like, all right, switch to cash flow and returns. I've seen them, during the COVID bubble, that when the companies were growing 100%, they're like, grow. Then they're like, all right, you're only growing 20%. You need to get to whatever rule of 40. It's a fun thing that people make up. And then, you need to cut costs, and management's all shifted to EBITDA margin and profitability. So they all listened to what the market wanted. I saw that in oil and gas when they were spending 120% of cash flow, and now they're spending 40, 50% of cash flow. Literally, all of the big CEOs and the Boston PMs got together. They were like little mini conferences, and that's a much smaller industry. Is Wall Street really going to be able to dictate what Microsoft does in their boardroom and how they spend? Because Wall Street, cares about 1, 2 years maybe. And these guys are thinking decades. So help me understand, and the numbers are good. It's not like they're growing 10%. They're still growing 30%. Help me understand has their messaging changed to capital discipline? Or more of the investors you're talking to, the big holders, saying, hey, we need capital discipline? It's not like the stock's been a dog either. It's been pretty strong. So help me understand why they're going to pivot.
Yeah. So let me first, big dose of humility. When we say Wall Street, we don't mean people like me. When we say Wall Street, what we mean is the global market for Microsoft shares, which is a very large group of investors and shareholders that have their voice really mostly through the board, not necessarily through that Welly or Fidelity PM, right? So for companies like this, it's really the board that's there to represent the shareholders at large. It's not necessarily any individual investor, certainly not the sell side, right? But having said that, yes, absolutely, Wall Street in that sense, in that broad sense, absolutely has an impact on them. Now, Microsoft peaked at 465 in July. So actually, they had tremendous performance. That stock doubled in a year, from June 23 to July. From July 23 to July 24, it more than doubled. But since then, their rate of investment has increased, has accelerated, and the rate of growth has decelerated. So yes, 30% growth in Azure is great, but by the way, that's an enhanced number. They restated their segments last quarter. In the old Azure reporting, it would have been closer to 20. So what they've done is they've taken a lot of different types of AI businesses and bundled it there. And by the way, more importantly, they have dropped the ball on a lot of the other businesses. So they moved a tremendous amount of resources into AI, into GPU rental, into Azure at the expense of other businesses. And they've even had to point out in this most recent quarter that even that core hyperscaler cloud hosting business had issues, had execution issues during the quarter because of all this over focus on AI. So what we've heard more recently, and we started hearing this in the quarter, interestingly, Satya Nadella started doing podcasts where he's talking about a recognition of what we're saying, which is there's been a period of overinvestment. It's probably over. We're going to moderate it and be a lot more thoughtful and focus a lot more on returns. And he's been saying that publicly. Now, in their most recent quarter, again, they said next 2 quarters, flat CapEx. And the next fiscal year, their fiscal year starts July 1st, will be up, but less than it was before. We don't know what that means. Even if they keep CapEx flat into fiscal 26, it will be up year over year. So again, Amazon's CapEx in 2025 will be up a lot over 2024, but it will be flat to Q4 of 2024. So if Microsoft says the same thing, we've gotten to that point of being much more responsible, which again is what the board is telling them. And in Microsoft's case, again, the board matters. They represent shareholders. There is a responsible perspective of generating returns, of increasing margins over time, increasing cash flow over time. We could talk about Meta and the dynamics there. That may be different, but in Microsoft, Amazon, and Alphabet's case, there is a responsibility to shareholders.
And is there a mix issue? And if CapEx is flat, people are going to say, well, there's more GPUs, less concrete in the data center. And any thoughts on that?
Yeah. And that is what they said, is that a lot of the increase in spend last year was literally a land grab. So there's finite land next to power sources. And so they were all in a mad scramble to secure that land and start working towards power agreements to provide power to those data centers. So they bought a lot of land, they leased a lot of land. That was most of the spend last year. And this year it's going to flip over and more of the spend is going to be on servers as they catch up. But another thing that Mr. Nadella said in a recent podcast is that he will no longer be supply constrained by the middle of this calendar year, by the end of the fiscal year. And I think Amazon said something similar, which is to say Nvidia will have caught up to the orders by the middle of this year. There will be increased spend on Nvidia, even in a flat CapEx, but they will be caught up by the middle of this year.
So the picture is essentially, these 4 customers, Microsoft, Amazon, Meta, and Google, are about 50% of the business. Meta probably still growing. These other 2 or 3, call it 30, 40% of the business, kind of flat sequentially. On CapEx at large, not necessarily the GPU spend. Nvidia has been growing $4 or $5 billion a quarter of revenue sequentially for the last 7 quarters. The street has the trend is your friend, another $4 to $5 billion every quarter. Just simple modeling, but their customers are going to kind of flatline. Well, not all their customers, but a good chunk of them are going to flatline. And the question is, who makes up that growth? Is it the mix shift in their CapEx, or are there new people to come in? And are there new people to come in that aren't supplied? I hear all this chatter about sovereigns or other people but I don't know if they buy the chips or they just buy the services from these big hyperscalers.
Let's segment the rest, right? So we talked about the big category of hyperscalers. We talked going to get more rational. What happens with the rest? So I'll divide up the rest into the following categories. There's internal usage / vanity. I'm going to put Zuck and Elon in here. There's China. There's neo hyperscalers. Let's call that self-dealing. And then there's they refer to sovereign. We'll talk a little bit about what that means. And maybe let's start with the good news. The good news is that Elon Musk, Mark Zuckerberg, and Sam Altman are in a data center measuring contest. And I use that D word instead of the D word I really meant to say, right? That's what's happening right now. All three of those men believe that AGI is within their reach, artificial general intelligence, superintelligence, the one model to rule them all, and are willing to invest their money, right? Especially Mr. Zuckerberg and Mr. Musk believe it's their money, as much of it as it takes to outdo the other guy. That makes that a great category of customers because vanity and ego are terrific motivators that can last for a very long time. And so let's make that NVIDIA's best category. The little caveat to that is Mr. Musk also invested in the Hyperloop for a while and then got tired of that and moved on to other things. Mr. Zuckerberg invested in the metaverse exponentially for a while, got tired of that. And Mr. Altman it's not his money. It's Masa-san's money. Another vanity play, not even clear that he has the money, right? So still, very good category because there's no rationality there. It's good for Musk's business because he does better self-driving. It's good for Zuckerberg's business because they sell more ads, but they're investing well beyond what those gains are to build the biggest, shiniest data center to achieve superintelligence. So let's put that aside as resilient growth that could keep growing for a year or two before they see another shiny object. The second category is China, right? This is an interesting and tricky category. ByteDance and Tencent and Alibaba are very big customers of NVIDIA. They're very big customers of NVIDIA, arguably not even included in what we call China here, because theoretically ByteDance is headquartered in Singapore, right? Because we know that they're not managed by the Communist Party. They're a commercial entity out of Singapore, right? So there's those guys. The Biden administration, with their diffusion rules, were already starting to restrict those types of customers, and definitely any other type of China customers, including companies like DeepSeek. And it's safe to say that we're going to do more to limit sales into that category. Now, if we don't, those guys will buy as many chips as we sell them. So NVIDIA has a bottomless pit to sell into.
We're selling the older chip, not the latest generation, the generation before that, right?
Oh, let's get off on that tangent for a second. They are allowed right now to sell into China advanced degraded chips. So chips that have either less memory or less bandwidth are still incredibly potent chips, but that's perfectly legal. They could sell those. It has been reported very widely, including by the Wall Street Journal, that they're also the most advanced chips. So right now, H100s, H200s are also selling into China because what NVIDIA does, and I'm sorry, this will sound harsh, but it's not something they've denied, is they sell H100s, H200s to their resellers, and their resellers then sell them to other people, and those chips end up in China. And it is not clear that that is illegal behavior because NVIDIA has plausible deniability. We just sold it to Dell and Supermicro. We don't know what they did with it. We have no records of that. All we have is the invoice from Supermicro. If they turned around and sold them in China, they broke the law. We didn't break the law. So if that persists, and what they just said in the last quarter is we don't expect it, our guidance does not anticipate any changes in our ability to sell into China, good or bad. But it's very possible. I mean, Jensen Huang was visiting the White House a couple of weeks ago, and he must have promised Trump something. We don't know what it is yet, but to believe that we'll sell more advanced chips into China, hard to believe. Now, again, if nothing happens and ByteDance, Tencent, and Alibaba continue to behave like they can buy advanced chips, then those are very good customers as well. But again, it's more reasonable to think that it'll get harder to sell to those types of customers as opposed to easier.
And those customers, I have Singapore at about 18%, China at 13%. Does that sound right? That's from the K.
Nobody in Singapore is using there's no GPU chips in Singapore. What NVIDIA has disclosed in their most recent SEC filing is that they categorize their revenue by the billing address. So
So it's about a third. A third of their demand is coming from China.
at
Yeah, I get
least,
it.
at
At
least.
least.
So I'd probably put it in the 30 to 40% range. So NVIDIA uses the term sovereign. I think they've said it's multiple billions of dollars of revenue. When you press them on it, you understand that you hear that category includes subsidies. So if the government of Malaysia is subsidizing a Microsoft Azure data center, they consider that sovereign. And in that sense, it's a little bit of double counting um, because you're counting it as a Microsoft as a CSP revenue, and then you're also at the same time saying that it's sovereign, which isn't to say that there's no governments that will be throwing money at NVIDIA GPU data centers. Are some Gulf states building big data centers, again, out of vanity? Yeah, maybe. Is that a consistent, persistent customer base? Probably not. Again, like they're not going to get any return on that investment. If you're the UAE and you're buying a bunch of chips, then you have your own sovereign AI, and you use it to train your models on only Arabic spoken in the Gulf, and it makes a lot better chat models in Arabic and all those things. Sure. Are you going to get a return on multiple billion dollars of investment doing that? Absolutely not. So that's a finite market of vanity purchasing by ultra rich countries. When they say sovereign, they mean that, but again, they also mean France is subsidizing, Malaysia is subsidizing, and therefore we're counting those data centers as sovereign. So I would put a little bit of a grain of salt on that particular segment.
I want to kind of switch gears a little bit, go into the competitive advantages and the barriers to entry, specifically the software, CUDA. People say, all right, you've got 80, 90% share now. Your biggest customers, two of the three already have commercial trips. Microsoft, I don't think, is too far behind. I've read in my expert calls from AlphaSense again that they want that to be 50% in 7, 8 years, 20% in 5 years, in terms of what they're using. And then I've also, just even if they're not using it, you can still use it as a bargaining chip because now you have two choices, not one. And there's also still there is, AMC, and I don't know where Intel is on this, but maybe just help me understand how defensive CUDA and the networking too make Nvidia, and how much of a barrier to entry that is.
Yeah, it is a very substantial barrier to entry. To be clear, there's a reason why they're at 90% share right now, which is they figured all this stuff out years ago. And it's not that nobody else had a chance. NVIDIA had a GPU product 15 years ago. AMD's had a GPU product for many years. They just couldn't manage the product out of a paper bag. And so NVIDIA's been running circles around them. And a big part of it is what you just mentioned, which is they have the firmware. They refer to it as software, but it's really firmware. It's the software that helps you coordinate multiple clusters of GPUs. That's the CUDA software. They made an acquisition called Mellanox a few years ago that gave them a proprietary networking component. So they don't just sell chips; they sell $50,000 boxes that are incredibly complex and potent and powerful. And that's how they got to 90% share. Again, back to that statement that this is a remarkable achievement that this company has made, and it's not a coincidence. It's a lot of hard work and a lot of terrific execution that got them to where they are. Having said that, when you're a 90% share and you are extracting value from the largest companies in the world, the hourglass starts flipping and counting down. We have had a massive transfer of wealth, especially from Microsoft, but also from Google and Amazon to NVIDIA. That's what we've had so far. Those companies, regardless of the shareholders and the boards, are very displeased about that. They're willing to tolerate it because they can turn around and sell that GPU capacity at a very nice margin. It helps them drive top line growth, which is why they're doing it right now. but they are all very much focused on diversifying away from Nvidia. They're by the way, they're a lot more clear on that in follow-up calls than they are on the public call, because Jensen listens to the public call. And the last thing you want to do is piss Jensen off. He, again, back to, remember how he's managing the peak? Part of how he's managing the peak is he's the person that allocates GPUs. He decides who gets what. He's the kingmaker, right? And so you don't want to piss him off. But on the other hand, when you ask Microsoft, Google, and Amazon, they will tell you that it is a huge priority for them to diversify away. Microsoft is late to the game, but Google has been working on TPU for more than a decade. Amazon's been working on their chips for more than 5 years. By the way, that's what it takes. It takes a really, really long time to get chips that are even in the same neighborhood of performance. But those guys did that because they realized that they didn't want to be beholden to one vendor that could charge them anything for that. And so they've been working on this for a long time. Now, as of a year ago, when I brought this up, the response was, yes, Google builds TPUs, yes, Amazon builds their own chips, but it's only for internal use. Meaning Google only uses TPU to deliver ads, and Amazon only uses their chips for their data centers internally. They don't actually provide those as a service to anybody else. NVIDIA has 100% of that market. Up until a year ago, that was conventional wisdom. That has changed because Google very prominently is now serving up AI services to Apple. Amazon very prominently is serving up TPUs for both training and inferencing for Anthropic, which is the second largest AI company after OpenAI. So we're already well on our way. And again, all these companies are very intent on diversifying away from NVIDIA. So 90% share is peak, even with those very substantial barriers to entry. Now, the other ding in that barrier to entry is the market is now so big and so important that everybody has to figure out something else around CUDA. Yes, CUDA is the best, it's easiest, it does the trick. You want to use it now because everybody uses it, all the developers use it, but again, I don't want to be beholden to NVIDIA, so I need to figure something else out. So TPUs, don't use that, right? And interestingly, and the most interesting development on that front is a subplot of the DeepSeek story, which is DeepSeek, because they didn't have access to as many of the most advanced chips as they wanted to, had to do something better than CUDA, and they did. So they built a better coordination layer software than CUDA, which makes their models perform at an order of magnitude better rate than the other models, because they've actually built something better than CUDA. So that may take time before it fully infiltrates the market and makes it possible to use other chips, but it's a very interesting development to note as well. On AMD and Intel, I'm going to dismiss those. They're useless. They can't compete their way out of a paper bag, not in this market. And so I don't necessarily think that they'll have any meaningful success going forward. We really are talking about the share shifting from just NVIDIA GPUs to a mix of NVIDIA TPUs, Amazon Trainium, and Microsoft calls it Maya. And they're not as far down the road, but again, they are very committed to shifting more and more of their capacity to their own chips.
Yeah, and those companies seem to have some sort of knowledge on building software capabilities around things. So,
especially Google. An interesting tangent is that we've done the work to show that if Google woke up tomorrow and said, we're going to sell TPUs externally instead of just having them in-house, we think they could take about $600 billion worth of market cap and shift it from NVIDIA to them. Their product per people in the marketplace is just as good. They just use it internally. They've never thought about selling externally. If they woke up tomorrow and said, not only are we using TPUs internally, we're going to start selling and competing with NVIDIA, we think they could take about a quarter of the market and therefore a quarter of the market cap from NVIDIA. Now, they're not going to do it, but that tells you that how advanced Google is and how how much farther down the road they are from everybody else in terms of being able to have their own capacity.
So before we get to kind of the stock valuation, I want to kind of circle back to just the core unit economics of, I don't know if you could do it on a GPU level, or you need to put in the whole data center because you need that to run the GPU. We talk about a GPU, I've heard, they go for 20, 25, $30,000. I don't know what's included in that. I know you can, rent them for anywhere from, on the spot market, call it for $1, $2, $3 term. I've heard 3 to 4, 7. Help me understand, what is the payback of a GPU? How long does it last? Like, if you're buying something for $30,000, are you going to make $30,000 a year in revenue, and then you get what's the payback like?
Yeah, I mean, so I've seen some work around this. It's still rough, but let's do a kind of a thumbnail back of the envelope to say that if you're buying Nvidia GPUs right now, again, it's about $40,000 to $50,000 for the box, and turning around and renting them out, you could probably do, with one key assumption that I'll circle back to, you could probably get a 3 to 5 year payback, 20 to 30% return on investment on that, and that's not bad. The critical assumption, all these models rely on, it's what you assume is that the price that you're going to be able to rent out that GPU capacity declines by 20 to 30% a year. If that's the case, then you could probably generate 20 to 30% returns, which again is a 3 to 5 year payback, which is a perfectly legitimate investment. That assumption requires scrutiny, though, because I think we just said that the decline in prices in the open market has been 50%. So the price that you can rent out a GPU over a year ago is gone down by 50% in the open market. What Amazon and Azure are doing is slightly different, and they can lock people into 3-year prices. But having said that, those contracts will come up for renewal in 3 years, right? And so if you didn't get the return on then, you're probably renting out that capacity for a fraction. Or in fact, back to our previous conversation, it's probably not even worth it for you to rent it out, because 3 years from now, those H200s aren't very helpful for AI. You're going to have to continue to buy newer chips to provide that. So you really have to depreciate those chips over 3 years. And if the price you can charge for the incremental chip goes down more than 20 or 30%, you may not get your payback. So the economics are good as long as the deterioration in price for renting out the GPUs is more moderate than it is today. There's very little reason to believe that the deterioration in price for renting out GPUs is going to be more moderate than it is today. In fact, it's safe to say that since NVIDIA is introducing products at an even accelerated pace, the depreciations actually and the deterioration in rental prices may be even more than getting cut by half every year.
How much of the market is the term market from the hyperscalers versus the spot market from other folks?
So right now, it's mostly the hyperscalers locking people in for 3-year deals. So that's where the market is today. But at some point, they're going to exhaust that market, right? Because again, everybody wanted capacity. If you're any type of company, you have to have an AI strategy, and you need to be able to tell them all these use cases, right? And for it to have all these use cases, you need Azure capacity. And so you've gone into a 3-year deal with Microsoft to provide you this capacity, right? And so we're at a point where that land grab on Azure and AWS is, again, mostly near complete, right? Those companies have told us that by the middle of this year, they will be caught up on providing that capacity mostly, and then they're going to build to new demand. And so that part of the market is again grown exponentially, but it'll probably start moderating. It's the other part of the market that's more interesting. Again, that spot market, that renting by the hour market. Again, Nebius and soon CoreWeave and others. And by the way, Azure and AWS will be able to rent out by the hour at some point too. They're not doing it right now because they can do 3-year deals, but the market will migrate more to that. Right now, that's the spot market's the smaller market. Over time, it'll become the bigger market because it'll be much more flexible. And again, then that's when you'll really start seeing the prices decline, make a kind of a step down, and then decline very rapidly from there.
Is there a way to kind of get into that market and look for, are there any sublets? I mean, that'll be the first indicator, right? If there's sublets, are they allowed to sublet it? That'll be the first sign that, hey, the term market is fully saturated. That's the first thing I would look for. I don't know how to get into that market. Maybe I'll check the expert networks.
Yeah, no, I mean, it's a transparent market. I could even send you the link offline. It's a pretty transparent market that you can go see who's renting what for how much. And there is a lot of subletting of capacity. And again, that's part of what's driving the prices down is maybe somebody committed to too many hours and they're contracted for it. So they turn around and provide that capacity elsewhere. That's already happening. Again, it's part of what's driving the prices down. And again, the prices have gone down in spite of the fact that these are the state-of-the-art chips, right? Nobody's renting out Blackwell. Lambda and CoreWeave and Nebius don't have Blackwell yet. So the price of H200s and H100 has got cut in half without there being a more advanced product. Once those guys have Blackwell, you can imagine the rental prices for H200 and H100 will vary. And this is by the end of this year, they'll have Blackwell and they'll have at least some capacity. You can imagine those prices will go down even more dramatically. And companies, entities, people that have that have leased a big capacity in H100 and H200 and don't want it anymore will flood the market. And again, those prices will likely decline. The Blackwell prices will start off very high because there will be initially limited supply. But what you just committed to a year ago, if you're renting capacity from Azure and you committed to a cluster of H200s for 3 years, that's going to be a lot less valuable. You're going to want to get Blackwell capacity instead. So what you're going to be willing to pay for H200s, H100s is going to go down substantially as well.
Are there companies that are paying term for 3 years at $3-4 a GPU and then like, oh, we don't need this, and they have to go rent it out at 1 or 2? Is that happening? People are taking losses?
That market is starting to emerge, yes.
And is there a way to track how much capacity is in the sublet market?
We're going to be trying to do that, yes.
All right, let's switch to the overall company. It's very interesting because I think you just got to break it down to the unit economics, and this is all before. I mean, Microsoft and Amazon and Google, their contribution to their chips is negligible right now, right? It's 10-20%. It's not significant,
especially in terms of what they're selling in terms of capacity. Yeah. They're mostly still selling Nvidia capacity externally. Internally, again, they're using for their own purposes. They're using a lot of their chips for their own purposes. But in terms of what they're selling externally, it's a very small portion of what they're using externally. But it's growing, and as customers mature and want some applications to be more affordable, they'll start renting more capacity from Amazon, Google on Amazon, Google chips.
Got it. Yeah. And I want to just tie it all together here where the rubber meets the road on kind of the stock and your numbers and your variant view. I'm looking at your numbers versus the street, and not for 26, but for 27 fiscal year, or essentially the 26 calendar year, off by, I think, a month. And your revenue is 24% below and your EPS is 27% below. You're at 408, street's at 557, and you're at about 179 billion of revenue versus the street, I call it 237. Help me understand why are you so different? What are you seeing that others aren't? And help me understand that big gap.
Our numbers are street low, and it's a lot of the logic that I just went through. But to kind of crystallize it a little bit, and first let's put it in context, right? We talked about the fact there's a very wide range of outcomes. There are people, if you look at that consensus number, there are numbers over 300 billion for next year. I think some people have 330. I think there's an industry analyst that talked about Nvidia doing 400 billion of revenue next year. right? So there's a wide range of opinions. It is our belief that of all that range of outcomes, the most likely outcome is that we roll over towards the middle of this year, meaning that we reach peak demand in the middle of this year and demand stays flat for a couple of quarters and at some points starts declining next year. And if that's the case, you get to our estimates for 2026 calendar, fiscal 27, which again is street low. And when I say street low, again, I mean lower than the 65 other analysts that cover Nvidia. So I just think the more likely outcome is that Microsoft gets on an earnings call in July and says, we're either going to keep our CapEx flat to where it was in the fourth fiscal quarter, the June quarter, or we're possibly going to consider scaling down. Again, Amazon's already said that they're flat. If Microsoft says that, Google reports after them says something like that, we're going to start seeing, again, that half of the market moderators start declining. And then it's really just a matter of how much NVIDIA has access to those other markets and how much they can put their supply into those other markets to generate any type of growth. We think it's more likely than not that they won't be able to put enough capacity into those other markets, and that in fact 2026 revenue will be down from 2025. Now, we'll find out within 6 months if that's correct.
And your numbers, I mean, you have it down $10 billion. It's not a collapse. It's just not, you're not continuing to add 4 to 5 billion a quarter each quarter. You're saying the customers flatten out, NVIDIA should flatten out, and you're not really incorporating, seems like a big China, Singapore fall off, which is a third of the business. And it doesn't also seem like you're incorporating much for, pricing and margin if you go from a one-person market to essentially a 2 to 3 person market with Google and Amazon. And I don't know if maybe that's the outcome. The volume keeps growing, but the price doesn't. Or they have, that could be part of it, right?
That's right. Gross margins will have downward pressure. They're continuing to introduce new products. The less excess demand there is, the harder it is for them to price aggressively. And so as if even small declines in revenue with OpEx ramping up and gross margins being under pressure would translate to considerably lower earnings as well. The bigger problem won't be the decline in earnings, it'll be the decline in multiple. We're trading at about a 30 times multiple right now because NVIDIA is still growing and they're expected to continue to grow at 20% next year. If they're not growing at 20% next year, or if they're declining per our scenario, we're not trading at 30 times. You don't get to keep that multiple if you're a declining business, even if it is cyclical. When companies tend to trend, semis companies tend to trade at peak multiples on peak earnings and then trough multiples on trough earnings. The market isn't very good at averaging out the multiple over time. And that's okay. Again, that's what makes those great trading stocks. But the point is that if we're right and their revenue and earnings go down next year, they don't even have to go down to $3. Even if they're just $5 instead of $5.50, then all of a sudden we're trading at 20 times that, at 15 times that, which is considerable downside. And so that's part of what's notable. And again, we're still in a minority opinion on this, which would make it a very big surprise. Let's not forget that the consensus expectation is 240 of revenue in calendar 26. And so anything less than that would have more of a multiple impact than it would an earnings impact.
That's kind of what we saw play out this quarter. You actually saw the beat on revenue, and the near-term beats got bigger, but the next year's beats got the growth sequentially kind of went to 1 or 2 billion a quarter versus whereas before it was 4 billion straight through. And it's funny, it all hinges on not even hitting that number. For the stock to go up, they don't just need to hit it. It needs to be revised up, right, for the stock to work. That's what I've seen over the last 2-3 years. The chance of it hitting it, maybe. The chance of them beating it and having the hockey stick go even higher, that seems like a long putt. And it's interesting, it's all predicated on, 2 years out numbers from Wall Street that has this trend is your friend model. And I've done that for years. That's how you model, right? This is how we do it in Excel. they only guide a quarter out. They don't even guide a year out. Microsoft knows that they're building data centers. They have CapEx plans. Their customers have budgets. I'm somewhat new to the semi business, and I have the mental model of other industries, but why do they only guide for a quarter?
Because that visibility isn't that good. Yes, Microsoft has a plan, and if all other things being equal, they'll execute to that plan. But Microsoft has also been clear about the fact that if they see any changes in demand, they don't have to order anything else. Again, they'll sit on the land. They already own the land. They're in a 15-year lease. If they see a change in demand over the next 3 weeks, they can change their plans for the third quarter, the fourth quarter of this calendar year. And so NVIDIA has short-term, very, very good visibility. Long-term, the visibility isn't quite as good. And that's why, I mean, Mr. Wong's been asked every single conference call about longer-term guidance, and his answer is always, well, here's my TAM, and I'm going to capture it in short order. And that's a very reasonable response, but it doesn't give investors what they need in terms of visibility into next year and the year after that. My TAM is 1 trillion, 2 trillion, whatever he says. Again, these are...
It's a percent of world GDP. Is that right? Do I have that right? That's a new one.
I don't know if he's... I think there's some conversation of that. But what he really is talking about is what's the installed base of data centers. They all have to get replaced. And then there's this, all of labor or most of labor is going to come from AI. And if labor is coming from AI, then that's $40 trillion. And if we capture a percentage of, he's doing some of that math. Others are doing some of that math. I think conceptually in the multi-decade perspective, that may be right. 2026 chip sales, probably not helpful.
I mean, they need to be replaced. It'd be great, but they're only going to be replaced if people are earning this 20, 30% return on capital that that they need to purchase it, unless we're in an arms race, which we've been in for the last, call it year and a half. Does Microsoft, does Google, these guys must see that their customers are subletting or that the spot market is a little softer. And it's on the internet. I mean, I found it like, do you ask them about that when you do your follow-ups? What do they say? Oh, that's not the core market. The core market's the term market. We still have a lot of backlog. Every company's going to use this in every industry. Like, how do they respond to that?
Yeah, well, I mean, so again, first of all, as we sit here today, there's still supply constraint, right? As we sit here today, they still don't have enough chips to meet, and enough data centers to meet the demand they've already sold. Again, Microsoft and Amazon have said they think they'll mostly be caught up by the middle of the year, but as we sit here today, they still don't have enough capacity to serve just the demand that they've already sold. So from that perspective, that's a good reason to continue to invest. But absolutely they see that, and they absolutely have their fingers on the pulse. And again, that's why I'll point to the commentary for Mr. Nadella, which is we've had overinvestment. That's going to moderate. He was the last podcast, I forget who he did it with, I think Dwarkesh, he was very clear about that. And again, he's good for he says, I'm good for the 80 billion, right? They're due to spend 88 this year, by the way. What's he going to do next year? It's probably not going to be a much bigger number than
that. Yeah. And then Amazon at the 100-ish mark, kind of flattish from here. Majority for AI, they've said, lion's share. Google's still rampant, but they're, these guys, I kind of tallied it up. The big four are going to grow at 3% per quarter sequentially, whereas last year they grew at 12.
That's right. Again, back to as good as it gets for NVIDIA. Like we should be getting close to that peak sequential growth from their big customers. And the sequential growth from here, it will be a lot slower. It really is. They do have to put a lot of that into the other segments. We maybe worth circling back to one of the other segments. We didn't get to it earlier, and I think it's really important to note. And I'll try to say this in a nice way, right? So you look at the Neo clouds. CoreWeave, the biggest one that will go public. Nebius already public. Lambda will probably at some point go public. Those are companies NVIDIA has invested in, right? So I want to be clear. NVIDIA will tell you these are arm length transactions, right? We invested in CoreWeave, and they happen to buy our GPUs, but those are two separate transactions. This isn't new in the business world. It's perfectly legal. I would like there to be more disclosures around that, but it's perfectly legal. But we can't pretend that that's the same quality demand as Microsoft, Amazon, and Google buying, right? If you had to invest in a company for there to be a customer, it's not as good of demand. And let's add to that. That analysis is only part of the story. The other part of the story is that CoreWeave turns that, call it $1 billion investment from Nvidia to a $4 billion round and borrows another $4 billion, then that's $8 billion of buying capacity of Nvidia chips, where Nvidia only had to invest $1 billion. It is also seems like, and the S1 just came out for CoreWeave, that Nvidia is a 15% customer of CoreWeave. So Nvidia is also generating revenue for CoreWeave. So again, perfectly legal. I would like better disclosures, but not necessarily very high quality demand. And again, that's what they're going to need. When the hyperscalers moderate their growth, this is where the supply is going to go, is to these companies that compete in that lower end of the market, right? That end of the market that's seeing the prices get halved in a year. That's where they compete. That's where the incremental chips are going to go. More of NVIDIA's revenue is going to have to come from those companies for NVIDIA to have more sequential growth.
And those are the companies they're supporting, not the blue chip customers that already have their work on the cloud. These are the startup AI sort of customers.
So two different stories. So Nebius, again, publicly traded company, is mostly supporting startups, universities, smaller customers that want to run by the hour. Actually, I think that's a pretty good market to serve because a lot of demand's there and will be resilient. And if you can be the low-cost provider, you can keep doing that well, even with competition from the traditional hyperscalers. CoreWeave a little different. CoreWeave has Microsoft as a 62% customer, meaning they're actually not serving that market. What they're doing is their Microsoft spillover. So until Microsoft has all the capacity that they want, they're using CoreWeave as extra capacity. We imagine that a lot of that is training OpenAI models.
Got it. Sort of like a sale leaseback sort of model, like their base load. If they start pulling back there, that could be a sign. Or if they keep growing there, that's a sign. So I wonder what they say about next year's growth when they do the investor roadshow. About are they going to have to talk about next year's growth? I guess they can say, well, these are their data centers. And also, it'd be interesting to compare and contrast CoreWeave unofficial forecasts that come through the analysts versus what Microsoft is saying if it's such a big customer. That'll be a good one too. Are they going to launch that? Do you know if it's being launched or they just filed?
They just filed. The S1 is public, which means, we could be weeks away. Market conditions pending, investor receptivity to that type of customer concentration pending. But assuming those two things are okay, we may get them going public soon. And to your point, doing the roadshow where they're going to get asked those questions.
Have they done testing the waters? Any feedback have you heard from select clients? Or
I imagine they've done testing the waters. We've heard fairly limited feedback about it so far.
Well, Gil, this is super informative. I'm very grateful you took the time out of your day. And I appreciate you sharing your knowledge with me and with everybody. And I hope to have you on the show again. So thank you.
Appreciate the conversation. Thank you.
Please make sure to follow Pitch to PM on your favorite podcast app and never miss out on episodes. This show is for entertainment purposes only. Please consult a professional before making any decisions. This show is copyrighted by Pitch to PM. Written permission must be granted before rebroadcasting.